Hello, everyone, and welcome back for another Indie Wealth Monthly Market Update. As always, I'm your host, Nathan Zimmerman, and today we'll be reviewing market results from May, checking in on year-to-date returns, and discussing what has been driving the markets higher. So the month of May was a strong one for the stock market, with the S&P 500 gaining more than 5%. This brought the total year-to-date return for the S&P 500 to around 10%, and this is all despite a 10% correction from late February into early April, caused mostly by uncertainty around the conflict with Iran and the impact it could have on global energy supplies. But we seem to have weathered that storm for the time being, and the market is getting refocused on what really matters, which is corporate earnings. Now, speaking of corporate earnings, here we're looking at a chart of corporate earnings growth over the past 25 years. And we see some bumps along the way, for example, in 2008 during the great financial crisis and recession, and then again more recently in 2020 when the global economy basically ground to a halt for a period of time due to COVID. But if you look at what's been happening recently, you can clearly see that earnings growth is accelerating. The companies that comprise the S&P 500 just reported earnings results for the first quarter of 2026, and the overall growth rate came in around 30%, which absolutely shattered the estimates from Wall Street analysts who were expecting around 13% growth. So we don't need to look any further than this data point to understand why the markets have recovered so strongly since the correction earlier this year. Over the long term, the primary driver of stock market performance is going to be earnings growth, and this next chart makes that abundantly clear. So this chart is simply the S&P 500 index performance overlaid onto the chart that we just looked at. The correlation is obvious. As go the earnings, so goes the stock market. Now, in short periods of time, this isn't necessarily the case. Lots of things can move the markets week to week or month to month, which is why we shouldn't pay too much attention to those shorter time frames. In fact, we just saw it happen during the first quarter, where the market fell 10% at one point because of the war with Iran. We know now that during that same time, earnings were accelerating, but the market dropped anyway. But eventually, the market has moved past that temporary situation and refocused on what really matters. And this is why it's important to focus on longer time frames as long-term investors. Now, one thing we're starting to hear a lot of chatter about lately is inflation. Yes, the inflation readings have been rising recently, but the headlines are misleading. The majority of the recent rise in inflation has been caused by oil prices soaring in response to the closure of the Strait of Hormuz in Iran. 20% of global oil supplies pass through that body of water, and right now that slim body of water is closed off. Now, basic economics tell us that if supply falls, prices rise, and oil prices feed into just about every part of the economy. But this is more than likely just a temporary situation. In fact, we've already seen oil prices fall from as high as $120 a barrel to around $90 a barrel today as hostilities in Iran have subsided. And when that conflict reaches its conclusion, I expect oil prices will fall even further and inflation readings will calm down. Now, the latest CPI inflation report actually just came out this morning and showed a 4.2% rise in inflation over the past 12 months. And this is much higher than we'd normally like to see, but this number is a bit misleading. If we look at the core CPI reading, which strips out energy prices, that number falls to 2.9%, which is right in line with historical norms. Now, this is an instance where the news will run with the big scary number because it's attention grabbing. But if we dig a little deeper, we see that things aren't as bad as the headlines make them seem. And when oil prices fall, inflation will likely fall back to normal levels as well. Now, getting back to the markets, we have seen volatility pick up recently. So far in June, the S&P 500 is actually down by about 3%, and the media is going to start acting like something is broken because, well, that's what they do. But as we have discussed over and over, corrections are normal. Let me show you. Now, above me is a chart showing the number of 5% pullbacks each year going all the way back to 1980. On average, the S&P 500 experiences almost 5 separate pullbacks of 5% or greater per year. Even last year, when I think we'd all agree was a pretty good year in the markets, we experienced 6 5% pullbacks. Pullbacks are just part of the deal. Do they sometimes get worse and last longer? Sure. But have they always recovered no matter how deep the correction became? Yes. Which is why the best course of action during volatile times is usually to simply stay invested and do your best to ignore the temporary swings. Now, do you want to do some math with me to back this up? The market has experienced 207 5% or greater corrections since 1980. 207, that's a huge number. But despite this, $10,000 invested in the S&P 500 and simply left alone would be worth $1.8 million today. And all you had to do was not react to the hundreds of corrections along the way. Now, that's easier said than done. Our natural inclination is to avoid things that cause us to feel uncomfortable. But that's why I'm here to help you stay focused and stay invested, even during the times when that may feel like the wrong thing to do. So that's going to wrap things up for this update. Thank you for tuning in, and please feel free to share this video with anyone that you think may find it useful. I'll post the video to our Indie Wealth Advisors Facebook page, so an easy way to spread the word is to simply hit the share button on that post. But other than that, I'll check in with you guys in a couple of weeks with my written mid-month update. Thank you.